In this video, I will show you the top 10 most missed, misused, or abused tax deductions I've seen entrepreneurs take through the years that I've been preparing tax returns. And if you'd like to skip the introduction, go ahead and fast forward to the minutes I posted below and go straight into the first deduction. Hi, I'm Hector Garcia, CPA, Advanced QuickBooks Pro Advisor, and professional tax return preparer. I've been preparing tax returns for over a decade, and for the most part, I help small business owners, entrepreneurs, self-employed individuals to prepare their corporate tax returns. There are 10 top deductions that they either fail to take, they take wrong, they abuse, or they misuse. And I want to go through one step by step to discuss which are the ones that you should be looking at for your own business and maybe different ways that you can see it or not see it in terms of whether it's something that you can take for your own business. Now, really important, this video is not tax advice. This video cannot be tax advice, and it's also not tax research. So you cannot save the video and use it and then in an IRS audit go back and tell the auditor, hey, Hector told me in this video that I can do this or I cannot do this. So you must consult with your own tax preparer, your own accountant for this. I implore you that you hire a professional tax preparer for this. If you don't have one, you can contact me, email me, and see if maybe I can help you. But you should retain a professional accountant for this because some of these things are really, really delicate. Now let's talk about the IRS for a second. So there are 28 million small businesses in the United States, and almost all of them file some sort of tax return, either a business corporate tax return, LLC, partnership, S corporation, C corporation tax return, or they file a return in their personal tax return if the business owner is a sole proprietorship or a single member LLC. There are reasons why people incorporate, and there's many legal reasons and branding reasons, but one of the main reasons people do so is because the IRS audits corporations less often than they audit individuals that file business activities under their personal return. Now, I will never, ever, ever recommend someone any tax strategy based on the fact that they will be audited or they will not be audited or the chances are being audited. But you can see for yourself. I will post a link below to the IRS stats where you can actually see the percentage of companies that get audited versus individuals. So the very first thing I would recommend, if you're an individual doing business in your own or filing a personal tax return with a Schedule C, you should strongly consider incorporating into a partnership, corporation, or S corporation to completely separate your personal books from your business activities. Not just because the chances of being audited are less, because I would never give that type of advice. It is because it allows you to truly separate your personal activities with your business activities. That being said, we're going to talk about a couple of deductions in which it actually mixes the concept of personal and business. And some of the misuses and abuses happen to be with not correctly separating the business aspect from the personal aspect. Now, on a second note, almost every one of my clients ask me the same question, which is, what type of deductions can I take against my business income? Or which of my expenses are tax deductible? That's a very generic question. I get it from new clients. I get it from existing clients. I get it via email. I get it in Facebook groups where we talk about the concept. It's a very common question to ask an accountant. What type of expenses can I deduct from my business? So let's start with the general concept that the IRS will allow you to deduct everything that is considered ordinary, necessary, reasonable, and well documented. So those are the four things that every expenditure needs to have in order for it to be deductible. Ordinary, that means that in a normal course of your business, that your industry-wide, it is accepted. It means that it's normal. It means that it makes sense. It means that it matches your income. All that stuff falls into the ordinary concept. There's also necessary. Necessary means that the expenditure was required in order for you to produce the income or it was incurred as a consequence of producing that income. So that encompasses ordinary and necessary. Then we got reasonable, and reasonable is really important because that's a very gray area term. There's actually no tables or numerical coding system in which the IRS figures out what is reasonable and what is not. That is going to be dependent on the taxpayer, on the auditor, on the tax judge in the event that you get an audit and you go to court. Reasonableness is something that each individual will determine, and that actually plays a lot into certain areas of the tax code where things are not so definite or well defined. And lastly, documented. By documented means that you have a receipt, that you have proof to back it up, that you can sit there and explain why your deduction is $5,237.50 because you have a tally of the expenses, or you have the invoices of the expenses, or you have bank statements or receipts, etc., etc. So that's what I mean by ordinary, necessary, reasonable, and well documented. If those four fall into play, you really don't need to know specific things that are deductible or are not. The answer is they probably are. That being said, let's move on to the 10 specific tax deductions that are usually missed, misused, or abused. Let's start with the home office expense. So if you're an entrepreneur, a business owner, and you do work from home, now you don't have to work the entire time from home, but you do work a little bit from home or part-time from home, you would have to dedicate physical office space to your business. In other words, you can't have toys, you can't have personal equipment. The office itself has to be completely dedicated to business. Your computer, printer, scanners, all that stuff. Now, you want to take a picture of that home office every year as proof that that space was used exclusively for office use. You also want to measure the square footage in that home office. And typically, we're going to take the square footage divided by the entire square footage of the house to figure out what proportion of those expenses we are going to take as a tax deduction. Now, we can use several methods to calculate what the deduction would be. We can use the specific expense method, which is when this home office is actually completely segregated from your house, not just physically, but also in terms of expenses. So if you have your own electric meter, if you have your own water meter, its own separate bathroom, is not physically connected to your house, you could actually take the real actual expenditures that you're making directly into the home office in order to make it deductible. But that's not very common. Mostly, you will have one of your rooms in your house that you convert into an office, and that ends up being, in essence, the home office that people deduct. So because of that, actual expenses are not that easy to figure out. So what we end up doing is we take the expenses of the entire home, including water, including utilities, including insurance, including your mortgage payment or your interest payment or your lease payment. You figure out what the entire cost of the house is. And by the way, not the mortgage payment. I meant the rental payment if you're renting the house. But you take the entire cost of the house and you multiply it times the percentage that is home office, and that piece is the one that ends up being deducted. Now, where do people abuse or misuse it? Well, in some cases, people will exaggerate the square footage or not use it exclusively for business. So this is where you want to keep a blueprint of the house. That way you can prove through the blueprint what that is. The other recommendation that I make, especially now that we're in the year 2018, is to make a few videos out of the year, like I'm doing now. I make a video from my home office. I do one sometimes from different angles, and I publish them in YouTube. Make a video promoting your business, make a video talking about your business, and that will be permanent proof that that room is used for business use, because you see a printer in the background. Obviously, I have a computer desk, I have my microphone, I have my computer. So this will be a very easy way for you to prove that, yes, in fact, you used the home office for business. Now, the other great thing about using a home office is you want to make that home office your base, your home base. You want to make that sort of the home address of the business. And let me explain why. Because when you drive from the home office to your customer's house, or from the home office to the store to buy supplies, all that mileage becomes tax deductible. All that usage of the vehicle becomes tax deductible. If you actually get an office and you don't get a home office, driving to the office wouldn't be tax deductible, right? It will only be the driving from the office to those customers, from the office to those suppliers. So you want to have a home office, and you want that to be your home base, and you want the home office to be sort of a full-time home office. That way, all your driving and traveling from the home office becomes tax deductible because this is your home base. Now, for other folks that don't want to, really get complicated with doing square footage and calculation of that sort, they can use a safe harbor policy the IRS has, where they simply just multiply the square footage of the home office times $5, and it caps at $1,500. In other words, if you have a 300 square foot home office and you don't want to keep track of all these expenditures and the percentage and the proportion, you can simply multiply the 300 times 5. That gives you $1,500, and you can take that as a deduction for the whole year for your home office expense. So if you want to simplify your life, you probably want to use that square footage times $5 rule. However, in many cases, the actual expenditures times the percentage sometimes becomes more than that. So you may want to work with your accountant to figure out which one makes more sense. The second one is vehicle expense. Now, this is really tricky. If your business owns a vehicle that is titled to the business, it is insured to the business, it is exclusively used for business purpose, and the owners of the business have their own vehicle, then it becomes easy, right? Everything related to that vehicle becomes deductible. But for most entrepreneurs, that is actually not the case. For most entrepreneurs, they use their own personal vehicle for business, or they buy a vehicle for the business and they use it for personal as well. So what you need to do is you have to keep a mileage log that basically keeps track of the mileage that you use for personal use and the mileage that you use for business use. Anytime you have a mixed use property like that, you have to document extra. You have to have additional documentation to make sure that you can prove that the business portion of that vehicle is business and the personal, it's personal. Now, for a lot of entrepreneurs that own two vehicles, right? Let's say the spouse owns a vehicle and the business owner owns the other vehicle. What I recommend is to completely make one of the vehicles exclusive for business use and never use it for personal, and then use the spouse's vehicle anytime they're going to do a personal errand or something like that. One of the ways to make a business exclusive to business use, or at least for you to document that exclusive use, is to add logos on it. So add vinyl, decals, logo. Make sure the vehicle itself looks like a walking advertisement. So it's not deemed as a personal use vehicle or a mixed use vehicle. So the more you make that vehicle exclusive to the business, either by parking it in the office or insuring it under the business name or having the title under the business name and adding decals on that, adding one of your employees as a secondary driver to the insurance, all those things help you build the case that that vehicle is used mostly for business, or I would say 100% for business and never for personal use. That way you can deduct the entire vehicle itself as a business expense. Now, the payment to the vehicle itself is not deductible if you borrow money to buy the vehicle. So if you have an auto loan, the car payment itself is not deductible. What will be deductible is depreciation. So basically you take that percentage of business use, and there's a table on every tax return form. There's going to be a table in which it tells you, depending on the year that you're using it, how much of it you can take as a depreciation expense. Where people misuse vehicle expense is they take the actual car payment, that's an auto loan, it's a vehicle loan, and make it deductible, and that's actually wrong. That's wrong in so many levels. The other piece where people make a mistake is to also figure out the mileage cost of the vehicle. The way it works is you can take either the vehicle actual expenditures or mileage. You can't mix both. So you do either or. Now, one of the great things about using mileage is that you don't even have to keep track of the gas or depreciation or the insurance or the maintenance of the vehicle. As a matter of fact, none of those things become deductible. And then you multiply the miles that you use for business times the IRS mileage rate, and you get that entire calculation will become your deductible vehicle expense. Now, in some cases, the actual vehicle cost will be higher than the mileage, and in some cases, it's the other way. Typically, it depends on how expensive the vehicle are. If your vehicle is a big truck, is a gas guzzler, you have a big interest expense on the loan, it is likely that the entire actual expenditure of the vehicle, between depreciation, interest, gas, maintenance, new tires, whatever, that may be higher than the mileage because your vehicle actually costs more than the IRS average. But if you have a lower cost vehicle, a vehicle under $25,000, it will probably be a much better advantage for you to use the mileage, because it is highly likely that the mileage will be a bigger deduction. And the nice thing is that they're both totally legal. So because they're totally legal, you actually have the choice. And you may want to work with your accountant on making that calculation times, the personal use or the business use to figure out how much would be the actual expenditure that you can deduct. There's two places where people typically miss or misuse this deduction as well. One of them is the down payment of the vehicle. People tend to miss the fact that they made a down payment of the vehicle. And if they made a down payment with their personal account, or maybe they traded in a previously personally owned vehicle, they completely miss the fact that that down payment is part of the value of the vehicle. So that's missed pretty often. Another area that's most often abused is luxury vehicles. Like, a surgeon could probably prove that they need to drive to the hospital in order to be able to perform a surgery. So a vehicle would be deductible. But could they prove that a Ferrari is necessary? I mean, that would be a luxury vehicle. Also, it falls into the reasonable or non-reasonableness category, which is the challenge. So it would be very difficult to prove that you actually need the entire cost of a Ferrari to drive to work, whereas maybe something less expensive would work. Now, I work with a lot of real estate professionals, and they make the argument that they deal with some, high income earners, and they're selling $1 million properties, and they need to impress these people or show that they're successful by having a nice car, a luxurious car. And I think that some of them could pass that off. I think for a lot of them, you could take a pretty expensive car and make it reasonable and necessary and ordinary, because a lot of sort of high power realtors do that. The problem is, again, you're going to be walking a fine line, a gray line, on what is necessary versus what is excessive. So you should have a nice vehicle, but make sure it's not so excessive that any judge or any IRS auditor would basically disagree with you with every argument that you would have. All right, let's move on to insurance. So there's a couple of things with insurance that need to be clarified here, because small business owners tend to have a lot of confusion about what insurance is deductible and that sort of thing. So we talked about vehicle expense earlier. So if we're talking about the insurance for a vehicle, just keep in mind that only a percentage of that insurance will be deductible if the vehicle is misused. So if the vehicle is mixed use. So if you're using the vehicle 50% for business, 50% for personal, then only 50% of that vehicle insurance would be deductible. Now, another type of insurance that people really think about is health insurance. Now, if you're an entrepreneur, if you're a small business owner, health insurance is deductible on your personal return. Now, your business may offer a plan to pay the officers for the insurance, and the business is actually making the expenditure, but the business itself will not be able to deduct it. The owners would. Now, depending on the type of corporation, if you have a C corporation, it is possible that the corporation can deduct the entire health insurance from the officers. But if you have an S corporation, in contrast, if the officer owns 2% or more of that business, that would not be deductible to the business. It would actually be income to the business owner in their payroll, and then they would deduct it on their personal return. So the short answer is yes, health insurance is deductible. However, the mechanics of it they're not as simple as other type of business expenses. Another misused or misunderstood insurance is life insurance. If a business owner takes out a life insurance on their life, and the beneficiary is their spouse or their kids or someone else in the family. That's personal life insurance. That is not deductible. That is not deductible in any way, shape, or form, not through the business, not through the personal. Now, if the business itself takes out a life insurance against one of the owners, because the owner is an officer and a key man, a key person to that business, and the death of that person would cause a huge decrease in the revenue or income of that business, then the business can take out an insurance policy where the business itself is the beneficiary of that policy. If that is the case, that's called key person insurance. That would be deductible through the business. Now, the key contrast is that personal life insurance, when it's paid to the beneficiaries, is not income to them, right? So if somebody passes away and the spouse gets $1 million, that is not taxable income. But if you have a business key person insurance and this owner of this officer of the business passes away and then the business itself gets $1 million, the business has to include the $1 million as income, because that $1 million is actually technically income replacement, and you were able to take a deduction when you paid it. So it only makes sense that if you take a deduction when you pay the insurance premium, you're also going to get income when you get that claim. So that's really the difference, right? So depending on what you want to do, if you're trying to take out a life insurance because you're trying to make sure the business remains open, active, income generating for your kids and your family that you want to leave behind, then take a key person life insurance and take the deduction from it on the business side. But if you want that insurance claim to be 100% tax-free, then you pay the premium from your personal funds. It will not be deductible through the business, but then the beneficiaries will pay no tax when the money comes in. So that's basically the difference between life insurance that's personal or life insurance for a key person in which the company itself is the beneficiary. Now, another side note, a corporation can actually give a benefit to their employees, including the officers. They can give a benefit of a $50,000 face life insurance. So if every employee in the company has a small life insurance that would pay off the beneficiary $50,000, even if they're just individual, their spouses, their kids, whatever, the business can actually take a deduction to that. So many a times you will have companies that purchase life insurance for their employees. They will gift or include as a fringe benefit that $50,000 value, and then the employees would opt to pay a little bit more to get a little bit of higher face value on those life insurance policies. So then you would have to split the proportion of the first $50,000 that the business pays is deductible, and then the difference is income. It's a deduction from the employee's paycheck, and it wouldn't be deductible to the business or to the employee either. Now, there's another insurance called supplementary insurance or additional disability or income replacement insurance, best known as for the company that offers it, AFLAC. A lot of companies can bring that type of insurance into the business and allow the employees to get that insurance, which is basically if something happens where they cannot produce income anymore, that insurance gives them that income replacement. Typically, that doesn't have additional tax burden or tax costs to the small business or to the small business owner, but the employees can have access to these special type of insurances and the benefits. So that's a little not so known fact about AFLAC and those type of supplementary or disability insurances. Now, another misunderstood deduction is charity and political contributions. Let's start with the concept that political contributions are not deductible in any way, shape, or form. They're also not considered charity. I know you're gifting the money to the political party that you support, but it's just not deductible. And I happen to agree with that deeply because obviously it will open itself up to a lot of corruption. So no political contributions, whether a business pays for it or a personal pays for it, is deductible. Now, charity is tricky because general charity, like giving money away to people or giving away your stuff, it's technically charity, but it's not deductible because you can't really document it. The way to document charity is to give the money or goods to an actual 501c3 organization, which is an organization registered with the IRS as a charitable organization. They will usually give you the receipts and the documentation of the valuation of what you're giving them. If you're giving them money, then it's easy. You know exactly how much you gave them. And if you're giving them stuff, you have to have a good estimate of the value of those goods that you're giving. And you have to give it to a charitable organization so you can have documentation of those. Now, those are not always one-to-one deductible. There are limits in how much you can deduct. Now, for a lot of folks, I actually haven't met anyone that's hit that limit or above that limit. So for a lot of folks, that piece is not that important. But a lot of folks that cannot itemize the deductions enough for them to really cause an impact, the charitable donations don't really give them any deduction because most people have personally individual itemized deductions that they can choose to take, or they can take the standard deduction, which in many cases happens to be higher than what many folks can take in their individual itemized deductions. So if you have any situation in which you give away, let's just say a number, $10,000 worth of charity, cash, to a charitable organization, and you have no other itemized deductions, well, as a single person, you're already going to get $12,000 of standard deduction anyway in the year 2018. So having that additional charity doesn't make any differences in your tax return. So it's not always a one-to-one benefit of giving a donation. So you don't always think that you're going to give a donation and it's quote-unquote tax deductible. It is possibly tax deductible based on all the deductions that that person can take. So that's probably one of the biggest misconceptions that people have, is thinking that there's a one-to-one relationship always to that deductibility of charity. Now, not always the case. Again, there are folks that give so much and have so much in itemized deductions where they do get that one-to-one effect. Now, one of the challenges that I've had, particularly during the year 2017, is that folks were donating to, let's say, a cause like victims of the hurricane in Puerto Rico, hurricane in Florida, hurricane in Texas. And if you're not running that through a donation, through a charitable donation, it'll be very difficult for you to prove that that will be a charity. So you can't just give a check to someone and claim it as a charity. It doesn't really quite work that way. Now let's move on to the big mother lode of misused, abused, and misunderstood tax deduction: meals and entertainment. So let's start with the concept of entertainment. And this is something that changed in the year 2018. So you want to pay close attention to the details of this. Up to 2017, you were able to entertain a client. You can take a client to a concert. You can take him to a football game, whatever. And because you are discussing business and you're entertaining a client that you do business with, you could essentially deduct that. So in the year 2018, they completely took away the capacity to entertain a client. Now, that being said, there was a concept of meals. Now, before the year 2018, you could take a client out to dinner, and because that's entertainment, that would be deductible. Now, the problem with that, and this was always there, that up to that 2017, that meals and entertainment was 50% deductible. In the year 2018, they changed the law so you cannot take entertainment, but you could still take meals. But the meals would have to be sort of working meals. So if you actually, and this is the way I interpret it, there's actually not enough clarity in the 2018 tax reform law to tell you, as of the day that I'm recording this, to tell you exactly the mechanics of it. But as I interpret it, you cannot use it to entertain your clients. However, if you go to your client's office and let's say, for example, you have a board meeting and you have a couple of employees and you're eating while you're working, then that's a business meal and that's kind of a working lunch. That would still be deductible, still 50%, but that would still be deductible, but nothing with the nature of entertainment. So if it's entertainment, forget it. You're not going to be able to deduct it. Now, there's a concept called meals for the convenience of employers. Now, prior to 2018, 2017 and below, you can actually provide meals to your employees for them to work late or to do working lunch, and that would be 100% deductible. But starting 2018, it's only 50. So the only rule you need to know is a business meal, a working lunch, or something like that, that would be 50% deductible, whether you eat with a client or with an employee. But you have to make sure that it's a working meal, not an entertainment meal. And that will be limited to 50%. Same deal with travel. If you reimburse an employee with a travel meal, that will still be limited to 50%. So that's the key change that happened in 2018, is no more entertainment. Now, that being said, an area where people abuse that quite a bit is that they took clients to places where you clearly cannot talk about business or talk business, right? If you go to a concert, I would even argue in a football game, it would be difficult to talk business. So what people abuse it is that they tend to, buy tickets to entertainment events that they wanted to spend anyway, with the excuse that they're taking a client there in order to take a deduction. So the 2018 tax reform, which I liked, took away the entertainment aspect of it. So now you can only really prove a business meal because it was used while you were conducting business. So that's going to get a little bit trickier to use, and you're going to have even more documentation in order to prove that. And that also falls back to ordinary, necessary, and reasonable. Now all those concepts of having documented meals are going to be very, very important. And for the year 2018 and beyond, you're going to have to just make sure you don't abuse at all that line of the tax code. Now, travel is another tricky one. Travel is another big expenditure that people misuse, misunderstand, or abuse. One of the most important concepts is if you have to take a business trip because you're going to close a deal, because you're going to visit an actual client, because you're going to visit a manufacturer, because you're going to promote your business in a trade show, and you have documentation that all this stuff is happening for real, then you're not going to have any issues, right? The entire business trip will be deductible. Now, the business trip itself will be deductible, but the meals portion of it will not. Okay, so that's an area that becomes a little tricky. So you have to separate meals from your general travel expenses. Now, travel will not be subject to a limitation, again, if it's 100% of business. But where people tend to misuse travel is they end up taking their spouse, their kids, or they take a trip to somewhere where they don't do any business, where they don't have any clients, where they don't have any suppliers, and call it a business travel. Now, that's a problem because remember, all audits are in retrospect and they go back 3 years. So if you have an expenditure, let's say 3 years ago, that falls into an audit, for a potential business opportunity that you were going to have, let's say in Greece, right? And you said, yeah, I'm going to go to Greece because I'm going to open a market there. And that was your excuse to taking a trip to Greece. Well, remember, the audit is in retrospect. So you had 2-3 years to do business in Greece and you did no business. What do you think the auditor is going to think? How do you think that's going to fall in tax court? So just remember that just having an argument for an expenditure doesn't make it deductible. You have to have the documentation and the follow-through to show that there actually was a business purpose behind that trip. Now, one of the things that I do, and I'm saying this in a public way because I'm publishing this in YouTube, is that I try to take all my vacations near or close to major conferences where I go attend and speak in, and then take 2-3 days off after, or take 2-3 days off before. Why? Because I can take the majority of that business trip, which is what I used to get there, and the hotel, and I can make all that stuff deductible. And then the portion in which I bring my wife and my kids, I don't put that in the books. That's actually a personal expenditure. But I'm able to effectively and document a mixed-use trip in which I can take the days that I was there, the days that I ate while I was in the conference, the hotel that I paid while I was in the conference, the travel, the Uber, the taxi, all that stuff. I make all that stuff deductible. And then the other piece, I just completely separate the times that I'm with my family. So that's one way you can sort of take advantage of the business travels that way. Now, what exactly makes a trip a travel trip? So the general concept is there must be overnight stay. As long as there's overnight stay, you make the case that is travel. So driving really far for an hour to see a client and then coming back is technically not traveling. So there has to be some essence of overnight stay in order for you to properly book that as a travel trip. Now, people ask me all the time, if I eat something in the airplane, if I have some drinks in the airplane, is that deductible? Well, that's technically travel meals, so that's fine, yes. What if I pay for internet on the airplane? Yeah, as long as you're sending emails or doing work while you're in the airplane, that payment to that internet service will be deductible as well. Now, you may want to look up, there's a government guideline for government employees for meals and travel incidental reimbursements. And there's a table, it's somewhere in the Department of Labor website, I believe. I'll put the links below in the description page, where you can actually choose the state and choose the time of the year. And it tells you what is the state and the city, and it tells you what is the average meals, travel, incidental type of expense, lodging incidental expenses that they reimburse a government employee. And you can use that as a guideline to see whether or not your travel expenses are above and below those guidelines. So if you see your travel expenses, including your lodging, your meals, your hotel, your taxi, all that stuff, if you add all that stuff up and it's way, way higher than the government standard, then that could be something that could be looked at as abuse or luxurious or unreasonable. So you may want to look at those charts just to make sure that you're within the correct guidelines. And if you have an employee that doesn't give you, the detail of the receipts and all that stuff while they're traveling, and you want to pay them a per diem on that travel, as long as you stay within those guidelines, you don't have to have specifically line for line, expense by expense, because you are paying the per diem. Now, you do want to make sure that employee does have a record of what they're spending, because some of those expense reports could be audited as well. But as long as you're within those per diem guidelines, you should be able to just pay that amount, and that would be deductible. Now, let's talk about employees and subcontractors. Probably one of the often heavily abused area of the tax code. So the number one concept that you must understand, and this has to be top priority, is you either going to have an employee or you're going to have a subcontractor. Generally, one person really cannot be both. So generally speaking, an employee is someone that you control their schedule, they're exclusive to you, you train them, they work within your guidelines, they use your equipment, they work at your location, under your premises, they fill out a timesheet, they charge per hour, they have a schedule. That's an employee. A subcontractor or an independent contractor is someone that uses their own equipment, they have full financial risk. If they screw up, you don't pay them, or they do it over. You don't really control their schedule, you don't control how they work. Now, most people, small business owners, once they understand how much it costs to have employees, because you do have to pay self-employment tax such as Social Security, Medicare, not self-employment tax, because you do have to pay Social Security, Medicare, unemployment, and in other cases, in some states, there's some special employment taxes that you pay. So most entrepreneurs just want to have subcontractors or independent contractors instead of employees in order to avoid paying those taxes. Well, that's not okay. The employees and subcontractors have to be classified correctly in order for it to be deductible. Now, another area people screw up a lot, is actually a very common issue, is you're going to have employees where entrepreneurs want to give them a bonus or a commission or an additional paycheck for performance, and they circumvent the payroll system and they give them a straight check or they give them a gift card. The problem is you can't have that dual relationship where some payments to employees you withhold taxes and you pay taxes, and some you don't. So once you have an employee, anything you pay them, not just their salary and their hourly rate, any bonuses, any of that stuff, you have to pay through the payroll system, and it's going to incur all those payroll taxes. Now, another important concept people tend to misunderstand is businesses cannot gift money to their employee. So there's no such thing as the business giving a gift to an employee. If a business pays an employee, that is compensation, no matter what. Now, can the business owner give a gift to the employee? Sure. And there are limits on the gift tax laws in which you have to pay gift taxes when you pay more than $14,000 a year or whatever the annual limit is for the current year that you're looking at this. But it's really important to just keep in mind, businesses do not give other people gifts. So if you pay an individual, you either going to have to report that payment as a 1099 as a subcontractor, or you're going to have to include it in their. Now, as I mentioned earlier, you can give an employee some benefits like life insurance with a face value of $50,000. For example, you can give that. That wouldn't be taxable for the employee, and that wouldn't be included on the payroll taxes of the corporation. You could also give other benefits like health insurance. You can match on the contributions to the retirement plans. And these are actually really, really important to give to your employees in order to keep them. So it really doesn't have anything to do with tax that you want to keep employees, but keeping employees will save you money in the long run because you don't have to retrain other folks. Now, there's other areas of tax law that allow you to reimburse an employee for taking, for example, going to college and getting an MBA. Now, so you can pay them up to $5,250 per employee if it's part of a benefit package that's available to all your employees. So that's really one way you can reward your employees, take a deduction on money you're giving them to go to college, and it's not included on the payroll taxes. Now, retirement plans or income deferrals is what we call in the tax world, a low-hanging fruit. Every single person, I think, in my belief, should be saving something towards retirement. Now, you can do this if you're an entrepreneur, if you're a business owner. You can do this by having a company-administered 401k plan. And it's called 401k because it's section 401k in the tax code. And what a 401k plan allows you to do is it allows the individual to put up to $18,500 of their salaries away for retirement. Now, that money doesn't reach the employee's pocket or the business owner if it happens to be on payroll. So it absolutely does not reach their pocket. It goes into a saving account and it cannot be taken out until the person reaches retirement age. However, that contribution to the 401k, the entire amount is a deduction from the employee's paycheck. Now, the other really important thing is the company can do matching, which means that the employee can put a piece and the company can put the other piece, and that other piece becomes deductible to the business. Now, if you have employees beyond the owners, you have to keep in mind that the 401k plan needs to be available for everybody. So if you are an owner and you want to set up a 401k plan for yourself and also do matching of the part that you're contributing so the business puts the same amount into your retirement plan, that needs to be available to all the employees. So that's another really important piece. Now, if you don't do a business administered retirement plan like a 401k, you can also do an IRA, a traditional IRA. And there are some limits in income. If you make over a certain amount, you really don't get the benefit. But you have all the way up to April 15th of the year that you're preparing the tax return for the previous year to put up to $5,500 in a traditional IRA and reduce that from your taxable income. If you're over 50, you can put $6,500. Now, the trick is you cannot have a combination of a 401k or some other sort of pension plan in combination with an IRA. The IRA is really designed for the folks that don't have access to some sort of company-sponsored plan. Now, another really misunderstood place in the tax code is the understanding of the difference between a cash basis taxpayer and an accrual basis taxpayer. In a nutshell, a cash basis taxpayer, let's say a business, would pay taxes for all their income they receive from their customers, whether or not they're part of open invoices or last year's work. All that stuff would be irrelevant. It would be when you get paid. That's what cash basis means. Expenses will work the same way. If you made the expenditure that year, if you actually paid it out, if you wrote the check, if you pay with a credit card, it becomes an expense that year, regardless on when you actually incurred it. Now, when you're an accrual basis taxpayer, and depending on the company size, and also if you make the election, you are actually going to claim income for invoices that you created, even though they didn't pay you. And you are going to claim an expense for bills that you received from vendors, from providers that you still haven't paid. So in the accrual world, income and expenses are tied to a document, to an invoice, to a bill that tells you when the income or the expense was incurred. In the cash world, it's all based on the actual movement of money. Now, in some cases, cash basis will save you money if you haven't received a big payment and you're going to get it the next year. So it will save you money that year. In some cases, accrual basis will help you if you have a really big expenditure towards the end of the year that belonged to that year, but you didn't get to pay it until the next year. You still get the deduction that year, even though you didn't pay it yet. So it's not really a place where you're going to choose a strategy for taxes. Like, you can't really choose to be accrual or cash, or even go back and forth based on what's better for you. That is more of a decision that has to do with accounting policy. But one of the most misunderstood, misused, and abused is the concept of the value of your accounts receivable, the value of your accounts payable, and the value of your inventory if you're an inventory-based company. So if you're an accrual basis taxpayer, and I would say 90% of my clients are, because as the business grows, they have to in order to have any sort of accounting that makes sense. But if you're an accrual basis taxpayer, you have to make sure that every single year you review all of your accounts receivable and you write off the invoices that are uncollectible. Now, a lot of my clients are afraid of writing off invoices because they think, what if in 2 years or in 3 years that customer makes good and actually pays me? Well, if that happens, claim the income then. But if an invoice has been open for more than a year and the customer has not been responsive and it just feels like they're not going to pay you, as long as you have good enough documentation, you want to write off those invoices and reduce your taxable income for the year that you wrote it off. So you're not going to go backwards and write it off as of the date of the original invoice. You write it off when it was official that you were not going to get paid. At the same time, same thing happens with accounts payable. People are all focused about reducing that accounts receivable, but they forget about the accounts payable. You make sure that if you have any accounts payable sitting in your books of bills that you haven't paid and they're sitting there for years, hey, it's time to write them off, because if you're not going to pay them, you can't really get the tax deduction from it, which you already did as an accrual basis taxpayer. So that's an area that people tend to misunderstand. Now, the other key element is the year that you're making the switch. So most people start cash basis as sort of the default treatment. That year that you make that switch from cash to accrual, it's typically not a big deal because you're going from no receivables, no payables, and no inventory to some sort of value. So you're going from zero to something, which is okay. But if you ever want to go back from accrual to cash, you have to make sure that that year when you convert, that you pay all your obligations in accrual basis before you can actually go back to cash. The IRS is actually not that okay with you switching back and forth. You can make an election to go from cash to accrual at any point in time, but once you are accrual, you actually have to ask permission to go backwards to cash. And if you do get that permission, you have to do special accounting procedures to make sure that you pay off all those accruals before you bring them down to zero, which is essentially what a cash basis taxpayer does. Inventory, it's one of the most sensitive ones because a lot of my clients, they do inventories at random times of the year, but they don't realize the most important inventory that you have to do, a physical count of all your inventory, is at the end of the year. Because if you are missing product, if you have things that were lost or miscounted, and that inventory is overstated, that means that you have a bigger dollar amount that reported in your books than reality, you're essentially going to pay more taxes. Why? Because higher inventory means technically less expenses or more potential profits. So when you reduce that inventory, when you write off that inventory, that write-off goes against your cost or reduces your cost and your taxable income. So that's a really important exercise to do at the end of each year. Review your accounts receivable, write off the uncollectible invoices. Review your accounts payable, make sure you don't have any bills there that you're never going to pay. And review your inventory in detail to make sure that your inventory valuation matches the reality, because if you have less inventory than you think, you're going to have a reduction on your taxable income. And the last one that's missed a lot are the startup expenses during the company setup process. So I have a lot of clients that before they actually incorporate, before they actually set up the business bank account, they go out and make all these expenditures on behalf of the business, like setting up the corporation in the state's website, like in some cases doing some research and development, buying some sample products, buying some office supplies. In theory, if all those expenses were made for the business, even though they were made before the business existed, as long as you gather all those documents, your business, now that has an actual bank account, now that has capital from the owners, can now turn around and reimburse you with exchange of those receipts and include that in the accounting of the business of that first year. Many folks forget that, and they kind of started doing the accounting from the moment the bank account started. But what you don't realize is a lot of times you're paying lawyers, consultants, accountants, and you're making all these expenditures outside of the business bank account, and it often gets missed. So make sure that, especially if it's your first year doing setting up your business, make sure you track all those expenditures that you may have made before the business started for the purpose of setting up the business, and you have everything documented. And also throughout the year, a lot of times when people's bank accounts, the corporate bank accounts, are not fully funded for whatever reason, there wasn't enough cash flow from customers, the owners tend to pay things out of pocket from their own personal account, from their own credit card account, from their own cash, and also fail to record those as business expenses or get reimbursed from the business properly, so those go in the books correctly. And there's one more bonus business deduction that, as of the day of this video, I cannot claim anyone to misunderstand it, understand it, use it, or misuse it, because it is brand new to the tax code. It's called Section 199A. You want to talk to your accounting professional about this. If you're doing your own tax returns, I recommend you do extensive research about it. Section 199A allows small businesses, which are going to be self-employed individuals doing tax returns in their own personal tax return, S corporations, and partnerships. Those three, which includes LLCs that are taxed as an S corporation or partnership, anything that qualifies in the small business realm is going to get potentially a 20% reduction of the taxable income if certain conditions apply. Now, there are some industries that won't have access to it or will have it in a limited way. There are some caveats that if it's an S corporation, you have to have so much in payroll. You definitely want to read up on this law, sit down with your accounting professional. You have to look at all the details and all the facts on the table to see. But this is a huge, huge tax break that they have given to small corporations. Now, in 2018, C corporations, which are sort of the standalone corporations that file and pay their own tax returns and are not linked to the owners in any way, those got a huge tax deduction. The tax rate went from potentially 35% at the highest down to 21%. But those are only C corporations. S corporations, partnerships, and self-employed individuals, sole proprietors, they pay taxes based on their owners' personal tax bracket. So there's no specific percentage I can give you because each individual owner, we have its own, each individual case. But that 20% reduction reduces that taxable base that is passing through the income from the business to the owner. Now, that's not a 20% reduction in taxes. That's a 20% reduction of the taxable income. So, for example, if your taxable income is $100,000, instead of you paying your taxes based on the $100,000, you will pay it based on $80,000. So it's actually a huge break, and it's something that, unfortunately, on this particular video, I cannot go into much detail about. We're going to wait until the IRS sends us all the details and all the instructions. And through the middle of the year of 2018, we should get a lot more clarity towards it. But it is important to plan for this early in the year. You want to check your corporate structure. You want to check how your business is segmented. You want to talk to your accounting professional about figuring out whether or not this law can legally be used to maximize the efficiency on how you pay taxes by simply just changing the form or restructuring the way your business works, or maybe documenting things differently. So that Section 199A was kind of the bonus, and this is just giving you enough information to be dangerous at it. The details will be extremely tough to follow, and you are going to need to decipher this with an accounting professional. Anyway, those are the top 10 most misused, misunderstood, or abused tax deductions that most small business owners fail to take, or they take in a wrong way. If you're looking to hire an accounting professional that understands your business, you're going to have to interview and spend some time talking to that person. My email is below. You can email me your tax questions, whether you're my client or not. I will do my best to help you. If you do want to work with me directly, express that in the email and we'll talk to see if it's the right fit. I don't do taxes for every person that contacts me. I try to make sure that I only work with folks in which I understand their business and want to do things right. But hopefully this video gives you enough information to know what to ask your accountant, or at least what to look for when you're preparing your own tax return.